Pay attention, everybody. I'm going to start to go through the charts of why this is the biggest macro trade in history. Firstly, I'm going to start with the Everything Code. The Everything Code is the proprietary thesis that we built a global macro investor that we actually now run our portfolio for Xpan, investing in the very best hedge funds. We use this Everything Code as the basis. And it's the one where I discover that the debasement of currency is kind of everything and how it's very cyclical and it's understandable and forecastable as far as we can tell. Obviously, things can change. Nothing is a pure, perfection. But I think this is right, and it seems to be proving itself out right. So firstly, we observe that over time, the trend rate of GDP growth has been falling in the United States and all around the world. Current trend rate of GDP growth is about 1.75%. Why is it falling? If you remember, trend rate of GDP is driven by three key factors. 1, population growth. 2, productivity growth. 3, debt growth. So let's address these three factors. Firstly, let's have a look at productivity. Productivity has been declining over time as the workforce has been aging, and that lowers the trend rate of GDP. Debt, on the other hand, has been rising. But what we find is that household debt growth actually stopped in 2008 because the banks just stopped lending to people. So it's just harder to accumulate debt. Also, corporates have also been paying off debt and have really not been growing as fast as GDP. But really, a lot of the debt growth is now driven by the central banks, as we all know. Currently, the US is running massive deficits and is financing it by issuing yet more debt. And we'll come on to that in a minute. But the key thing here, the thing that drives everything for the Everything Code and the world around us, the return on assets, the inflation, everything is driven by demographics. So here's the working age population, aged 15 to 64, trend rate of growth. It's been declining over time as the population ages. Those people are less productive. The older you get, the less productive you are. They had borrowed debts in their early years and now are debt tapped out. So this explains a lot, and I've talked a lot about this on Real Vision in the past. But we can also project forwards. And if you remember my piece about the retirement crisis, I've been introducing this chart for a while, which is the labour force participation rate versus the births-deaths rate. This is the births rate going forwards by 14 years. And obviously the birth rate drives how many people in the labour force over time. And it suggests that participation in the labour force should continue to fall over time. Now, we've had some pickup as part-time workers have come back into the workforce because people don't have enough money, and we'll see some of that too. But over time, we're going to see the labour force participation rate falling because the replacement of new people in the population is not as much as people leaving the workforce. And that is the problem that slows economies. It's affected Japan, now affecting China, South Korea, Taiwan, and most of Europe. So anyway, that is the megatrend. But this megatrend has some special qualities. When you strip everything out, and I keep saying demographics is everything, you find that the labour force participation rate is exactly mirrored by US government debt as a percentage of GDP. So what it says is as the less people in the labour force, the economy slows, but there's all of the services to pay for the old people, the government debt increases. That correlation is stunning, and that is an incredibly powerful chart to understand the world we live in today, why governments keep issuing debt, and eventually why they're having to print money to solve it. It's all a function of population. So what they do with that debt is they add liquidity into the system. That's the debasement of currency that I've talked about. And you can see the correlation between Fed net liquidity and the US government debt as a percentage of GDP. They're basically the same thing. Yes, the scaling's different, but overall, the trend is the same. So they're using liquidity to pay for the growth in debt by debasing the currency. It's called financial repression. The other stark thing that we found in the Everything Code is actually the real mechanism is that most of the government debt increase is just paying interest on existing debts. They're not actually borrowing a lot more to invest in the economy. It's basically servicing of old debts. And so there is a very strong correlation between the interest payments from the previous cycle and then the liquidity for this cycle. So i.e. they issue new debt, it comes up for renewal, they've already been issuing new debt again this cycle, so to pay for the interest payments from the last cycle, they debase the currency via Fed liquidity, so they're increasing liquidity into the system. Now look at that curve, that's the expected path here, driven by the interest payments from the pandemic debt, which was a huge increase in debt. Now this debt keeps compounding, obviously, because you're adding debts on top of debts on top of debts on top of interest payments. So I don't expect it to play out fully like this, but we should expect a big increase in liquidity going forwards, and that's crucial to the theory. You see, look at that trend of total liquidity. Think of it, again, in a different world. That is the ongoing trend of debasement of currencies. That, when you debase the currency, gives you an optical illusion that asset prices are rising. So this chart of the NASDAQ versus the total liquidity index shows how correlated they are. It's actually 97.5% correlation. Now the NASDAQ actually outperforms this because it's a secular trend. But this debasement explains almost all of the movements of all assets over time, which is why everything is so correlated. Yes, some things lead, some things lag, but this is the crucial chart to understand. The answer to the demographics is more debt. The demographics is causing a slower economy. And to get over that, they issue more liquidity, debase the currency to pay for it. That makes asset prices rise. This is the Everything Code, and it's really important. You see, most people don't understand that this is the global liquidity index from all the major central banks. It's growing at an 8% annualized rate. Now, once you add in global inflation, and let's call global inflation about 4%, you've got a 12% hurdle rate for any investment. Now, that's pretty staggering, because if you think about the S&P 500, it does about 12% a year. So basically, you're not getting ahead by doing it. Your savings aren't accruing future value, just present value. This 12% hurdle rate is a huge problem for people if you don't understand it. You are basically getting poorer if you don't hit your 12%. So if you're just investing in bonds and think it's a good idea to get the 5% interest, well, your future self is getting poorer.
Thank you for joining us today on this insightful journey into the world of crypto and investing. If you found value in today's discussion and want to stay updated on future crypto news and market insights, don't forget to hit subscribe button below and click the notification bell. By subscribing, you'll be part of our growing community, gaining exclusive access to timely analyses and strategies. I look forward to having you with us in the next video.